Good morning, ladies and gentlemen. Well, overall, I think a very disappointing week, insofar as the Bulls have fumbled just as badly as the Bears. The scores oscillated all week, as you can see, and we actually closed on the lowest level, and slowly we are turning. Just like last week, I said that the old was dying and the new cannot yet be born. Now we just see the confirmation that we are in a period of mean reversion in prices as opposed to a period in trend. We had every chance. The dailies are slowly turning. The weeklies are not yet ready to turn, but we will be having 4 weeks of prices going below the top moving average, and that indicates that we are slowly turning from one type of market into another. As always, we start off with the yield curve and what the bond market is telling us. Here we have a weekly chart of the 2s, 10s, and we are 1, 2, 3, 4, 5, 6, 7 green weeks of an extremely strong trend. If we turn that to a monthly chart, we can actually see now how far the yield curve has steepened over the past few months, and we can actually see where it's ultimately going and where the huge resistance is, and that is here at 179 to 180 basis points. It is likely that this trend is coming to an end. After all, it's been going on for 1, 2, 3, 4 months. If we get here to 180 basis points, I am going to be a very aggressive seller of 2s, 10s, looking for a move back to at least this kind of 125 basis points. This kind of steepening is just cannot keep on going on. We're very close to being able to put on some trades at the level that we want to, and that is around the 180 basis points. This kind of behavior afterwards is more than likely to happen, i.e. a mean reversion back down towards 125. The other parts of the yield curve are actually very interesting and tell the story of what is happening. In the 5s, 30s, we are just not breaking decisively this 154, 155 basis points level. We're at 157, but we were at nearly 170 during the course of the week. So we keep on returning to it, which basically means that the pressure is going away from the very long end, i.e. the 20s and 30s, and is actually coming onto the belly of the curve, which is around the 5 to 10 year area, 5s to 7s. And that actually makes some sense. The market is not yet ready to say that the Fed cannot control the yield curve, and that inflation is going to rip-roar and not be controllable. We have not yet lost faith in the ability of the Fed to control things. So you can see what is going on in 5s, 30s, how it's actually relatively stable. And if we actually have a look at another chart, which is the 30s against the 10s, you can see how we actually, since the beginning of 2020, and this is when the COVID crisis struck, we have not really moved that much. We've moved like 20 basis points. And this is telling me, and we are still in the same range that we have been since June of last year, between 80 basis points and 65 basis points. And this is telling me that the pressure is definitely going off the very long end, and it's being piled on to the fives and tens. The market is saying that the Fed at some stage is going to have to start tightening, or at the very least abandoning QE. And this is, and this is what you would expect. You would expect the 30s to start stabilizing first, and then the pressure to move onto the fives and tens, as people say that the time when the Fed is going to act approaches, becomes nearer. But look at what is happening to the fives, tens. You can actually see that the pressure is more on the tens than the fives, and that is the result of the FOMC, where the expectations have been pushed out a little bit further. We're looking at 2023, 2024. Now we're looking at 2024, 2025. And we are getting more pressure on the tens than the fives. I would have thought the tens can still be relatively weak, where the fives are going to be quite stable. So you can see that the absolute yield level of the 30s seems to be quite happy, as it were, and the pressure is in the tens and in the fives relatively, but more the tens than the fives. So we are going towards this kind of level. We're going to 114 basis points in the fives, tens, and that indicates that the steepening is going to be pivoting around the tens. All this translated into absolute levels of the various tenors tells us that 30s have basically done most of what they're going to do. They're the ones that anticipated the inflation. They're the ones that got to their targets first. If we look at here, TLT, basically it's saying anything between 132 and 127 is going to be a very decent bounce area. How big is the bounce going to be? Well, probably all the way to 140, 141. And that is quite a reasonable thing to expect. If we look at the tens, what we are looking at is basically a spike into these kind of levels, which is 185 to 195. And once we've got to those levels, that will be the tens done, and we will be, we can have a period of consolidation and retracement in the tens, say from 195 down to 167, that kind of range. But if we look at the fives, let me expand this chart, we are looking at some stage at a move back down towards the 79 basis points, and then finally a spike all the way, when we are good and ready, which is going to be quite some time, all the way to 117. Basically what this is telling me is that sometime over the next couple of weeks I am a buyer of TLT, first of all, all 30-year bonds, and only after that am I a buyer of tens, and only after that I'm a buyer of fives. In fact, fives I really don't like. I think they've got very little value in them in absolute levels, but the yield curve is telling me that the trend that we've been having, which has been so powerful in both bonds and 10 years, is slowly coming to an end, with a favoring of 30s when they get to the levels I've just shown you. This is a chart of the differential between 10-year notes in the States and the Bund. I would have thought anything here between 208 and 220 is going to exhaust this trend. We are basically now back to where we were beginning of the COVID crisis. The market has undone the whole move of the COVID crisis, and that should be enough for the time being. I would have thought that somewhere between, as I said, 209 and 220 basis points is going to be the end of the trend in tens in the States, and also the end of the weakness of the bonds. I'm going to have a look at the bonds and the bubble next. I think that it's quite clear that the bubble is stronger than the bond, and basically it's now trading between minus 68 and minus 52. The bubble only starts being troublesome above this level, minus 52. I don't expect it to happen. I think the ECB has things very much under control, but if we start comparing this to the bond, and here I've put it on a monthly chart, you can really see that unless we start breaking above minus 17 in terms of yield, this is just a holding pattern, and the ECB is doing its job. On a daily basis, you can actually see it very clearly that we are just meandering between levels. I really don't expect this minus 38, 39 level to be broken anytime soon, but the real level that we will know when the trend in bonds has started, because things go in waves in fixed income. We could easily get a trend at some stage over the next 6 months where people start saying, what is the point of owning negative assets? It could happen, but we will know when it happens, and then that is when it breaks minus 17 on a weekly closing level. Before that, I would have thought that any dip down to minus 22 is a buy, and anything that goes down here and closes this gap around the minus 41 level is actually a mean reversal buy. I think the bond is less stuck than the bubble. The bubble, the ECB is managing to control perfectly. The bond naturally, because of the steepening of all the curves, is harder to trade. But I would have thought anywhere between minus 22 and minus 17 is a great risk-reward level to go long of the bond, because I don't think the ECB is going to allow things to get out of hand anytime soon. If I'm correct that we are in the very last stages of A, the steepening of the yield curve, and B, getting to the absolute levels of TLT and 10-year notes that we're going to get to, that means that one of the props that has been keeping DXY up is about to disappear. If yields stabilize, and if the differential to bonds starts not disappearing, but not going up anymore, not being in trend anymore, a very important stabilizing factor for DXY disappears and allows it to move down. I think it's very, very significant that at no stage have we managed more than a couple percent rally in DXY, and we have been unable to penetrate the 92.62 level and not get anywhere close to 93.14. That to me says that we are very close to turning. You can see how on the weekly charts, and you will see that this is a feature of all weekly charts, we are getting the Bollinger Bands to compress. You will see this is a feature in the equities, this is a feature in fixed income, and it's becoming a fixture also in DXY. To me, this indicates that the path of least resistance in DXY is going to be down to the downside towards 90. And if we turn this to a chart of the euro, this actually tells me that any move, if you have a look on the weekly chart, then any move down to 118.40 is going to be a wonderful risk-reward opportunity to play for a return towards 122, 123. Both this chart basically doing an ABC down corrective on the dailies and the weeklies, and the DXY that I've just showed you tell me that the path of least resistance and biggest risk reward from roughly 118 is going to be to the upside towards 122. Gold is actually anticipating the end of the trend in bonds. It's had 2 weeks of very good stability and slowly pushing higher. I'm relatively impressed. Does that mean that I'm a huge buyer of gold? No, it's still stuck as the middle asset. The one that is neither bullish nor bearish. Bonds are still bearish, but as I've explained, I'm looking for stability to slightly better things happening there. And this is reflected in gold. I think gold will probably trade 1763 and probably slightly exceed it, and probably even get to around 1810. But that's about as far as I can see it going, unless bonds really turn and unless the dollar really turns. It's a relative stability market. I'm impressed that it didn't touch 1658. It just managed to stay above it and push higher. I would have thought that a test of this 50-day moving average around the 1800 level is more likely than not over the course of the next week or so. And it's basically an asset which is stopping the trend down, and will, like most things, probably go into a meat grinder range between the 1810s, 1820s, and down towards the 1650s. What is interesting to me is that although bonds had a pretty bad week, equities had a slightly worse week. If you have a look, the ITOT government chart, it actually came back slightly on the weekly basis. This is a daily chart up here. It just shows you that equities are really getting to the edge of the envelope as how far they can go for the time being against government bonds. We need a period of stability to retracement. We need to probably do a sideways action for many, many weeks before we will be in a position to start pushing up the ITOT government chart. That tells me that the trend that we've been having of outperformance of equities over everything is probably coming to an end, or has come to an end, and that we are going to go into a very nasty chop, probably in all markets. We've seen how the dollar can start coming down. We've seen how gold is actually anticipating a turn in bonds. We've seen how the yield curve is saying that we are at the end of the move in the 30s, and that is probably now getting hit on the 10s, and then we'll get hit on the 5s. So what all of this is saying is that the trend that we've been having, the very clear trends, are coming to an end, and all of these markets are going to start going sideways and really be in a very nasty chop for an extended period of time. You have to say that if this is, that as I'm postulating that this is close to the end of the trend in the bond markets, you have to be impressed by how well the tech sector has really held up, because the damage has not really been that great. Yes, XLF against XLK, this chart here is well higher than it was, but it's not hugely higher. XLI against XLK, yes, we are higher, but look where we came from in beginning of 2020. This is where we were when COVID struck, 0.87. So we are, a good 12% lower. And even NDX against SPY, and this is basically the same chart now, this is the Qs against SPY, is holding the range that it's been in since June of last year. It had this feint outside, and I was getting very excited, and I thought we'd trade this level where I wanted to buy it. Nope. Yes, the moving averages are turning, but really it's been a very impressive performance by tech. It's held in relatively well, and that actually augurs well for later on in the year, when tech might be in a position to lead again. It's not going to happen for a long time. Okay, we're going to be in this kind of meat grinder for quite some time to come, with all the danger still being on the downside, I think. But if this is all that it's managed to do in terms of retracement over the course of best part of 9 months, you have to be impressed, and you have to say that there is long-term strength in the tech sector. Onto the equities, and you will notice that nearly every single weekly chart is the same. It has these Bollinger Bands which are beginning to come in. Transports are the only exception, but here you have a doji week, and actually we are above the Bollinger Bands, so this market will probably get the same look next week or the week after. Basically saying everywhere that we have exhausted the upside and that we are in for a period of slight retracement. Whichever chart I look at, same pattern, please notice it, and it's just a small warning sign. I'm not saying the market is going to fall apart. I'm just saying that they're probably going to test the downside in everything. Let's go through every single equity chart, and this is the weekly. You'll notice how the Bollinger Bands are now coming in. A sign to me that we will remain below 39.43, and really we have what have we been doing for the past X months, certainly since the beginning of the year. We've really been in a range between 37.11 and 39.43, and that's what, a 5% range. That is very reasonable. We are allowing this moving average to catch up. We could easily have falls over the next few weeks towards 3,800 or even slightly lower, but that is nothing, nothing to write home about. If we, it's not a change of trend or of any sort. Really, the 38.59 to 38.61, I think, is going to catch it the first few days of next week. Probably have a move higher back up over 3,900, 39.40, and then we might come down towards the 37.73 area, which is definitely going to be a buy. But you can actually see that we keep on failing to close the week above 39.40, 39.50, and that to me says that slowly we're deflating this. We, through time, we test slightly lower levels. I would have thought that 38.61 at some stage next week has to be tested, but it will hold for another move back up towards the 39.50s, and then slowly deflate this whole thing. NQ is actually ahead of SPX, as it so often is, in terms of its retracements and in terms of its consolidation. But as I've been saying, if this is all we're going to get, if we're not, it's very clear now that unless we see a move below 12,440, which is this previous peak and this battle level here, we are just, in a nothing period. The upside is very clear too. 13,312, and you'd have to see pretty strong closes above there, and I don't expect them for some time. I would have thought the next couple of weeks are going to be in a sign of testing the downside and bouncing and holding in while these Bollinger Bands come in, and then the pressure will start building and we will be able to start expanding. Naturally, I think the expansion is going to ultimately resolve itself to the upside, but I think that we are we have a period ahead of several weeks of smaller ranges, and that also makes sense because volatility has been coming down. As mentioned, even YM, the Dow, which has been the strongest market led by the financials and industrials, has managed some kind of a doji on the weeklies, and also we have a very clear coming in of the Bollinger Bands. If we try to, to me, this is a sign of a market which has had enough. It's done too much too soon. Do we trade back down to these levels? Would make sense, 31,200-ish, 31,000, something like that. Look at all those highs and lows there, just above 31,000. That's the kind of moves that we're looking for. Consolidation moves, deflation moves, things which are healthy for the longer term. When you get exactly the same picture in all markets, you really have to take note. This is the DAX, same pattern on the weeklies, indicating a move back down towards the 14,000 area, nothing huge. This is now the stocks, same thing, indicating a move down towards 36.45. To me, this is all very healthy. It's nothing to be really worried about, while it only, this is all we get. One day at a time, I see no reason to get excited on the downside, simply because I still like both the DAX and the stocks. I think they're going to be leaders. I think it's going to take a few weeks of sideways action before we can start moving to the upside again there. As I've been saying all along, it's only when all the indices are ready that we can start moving. Now, the Nikkei is telling you the same story with this kink now in the weeklies. It's basically saying that we have a very good chance of trading to at least a 23.6% retracement area, which is 27,100. Why not do an ABC down to there? Really no reason. EM is actually telling you the same story, same kink. All the markets are telling you the same. Would really love to see a retracement here to 50.23. I think that will be a wonderful level to buy calls in EM. I think EM is a long-term outperformer from these levels. Every market is saying the same thing. Some are more advanced, like EM in its retracement, some are less so, like DJI, but every single one is telling you the same story. And the spread that I showed you earlier against iGov tells me that if we are coming to an end in this period of severe underperformance in TLT, then we are probably likely to get a bit of money moving into TLT and out of equities. not a huge rebalancing, but a little bit of rebalancing, and that is just going to keep the pressure on to equities for the next several weeks. Well, if I'm right and the pressure is slowly, sector by sector, going off the bonds, then if we see 179, we are really going to be in the two stands, we're really going to be presented with a wonderful opportunity to short it for a move of about 40-50 basis points back down towards the 125 area. The interesting thing is the 530s, however much they go away from this 154, 155 area during the course of the week, by the end of the week they're back there. That tells you this is so obviously an important level. And as long as we don't have a crash through it, then the possibilities of rallies in TLT down here are still present, absolutely present. DXY, I've told you what I think. I think now the possibility of a deflation of DXY is coming to the fore. It naturally depends on what the yield curve does and what TLT does on an absolute basis. But if I'm right and the pressure slowly starts going off bonds for the next several weeks, then it should start going on to DXY, and that makes gold slightly more attractive in terms of help from both TLT and possibly DXY. Unfortunately, we didn't get the 1650, 1660, but that should help it. If what I've been saying comes true, that should help it go up towards the 1810, 1820 over the next several weeks. SPX, the bulls no doubt fumbled last week. They had a open goal, they didn't take the shot, and now 38.61 becomes the really important level next week. Only below there do we have a serious problem, something targeting the 37.70s. I don't think it's going to be quick. I don't think it's going to be very clear. I think people are going to be in this meat grinder for a long while, say between 38.61 and 39.50, and one moment you're bullish and next moment you're bearish, and oh my god, and relief. I think people are going to lose money both ways. I'm quite impressed with NQ. The fact that it didn't test the downside, and really only below 12,440 do we have a breakdown. But I don't think that NQ is going to be the one under pressure, if I'm correct in my view of TLT. So there you have it. It's going to be a tough week. I don't think it's, and probably more than 2 or 3 weeks. I don't think that we're going to have very clear trends in anything. And it's going to be a tactical market where you grab a few points wherever you can. Thank you very much indeed, and tweet you on Monday.